Ford is now facing one of its biggest challenges yet. A growing trade war has forced the company to halt exports, suspend its financial outlook, and prepare for billions in potential losses. It's a major turning point for the entire U.S. auto industry. Tariffs are driving up costs, reshaping global supply chains, and putting American jobs and car prices on the line. The current crisis didn't directly start with Ford. It started with a trade war between the world's two largest economies, the United States and China. It began when the U.S. imposed steep tariffs on imported goods, including a 25% tax on vehicles and auto parts coming from abroad. The goal was to protect American industries, reduce reliance on foreign manufacturing, and bring jobs back home. But China hit back hard, slapping tariffs as high as 150% on U.S.-made cars in retaliation. That made American vehicles significantly more expensive in the Chinese market, effectively killing demand and sidelining U.S. automakers. While the intention behind the tariffs was to give U.S. companies a competitive edge, the result has been the opposite. Global supply chains are disrupted, production costs are rising, and companies like Ford are left scrambling to respond to an increasingly uncertain trade environment with little room for error. Before the trade war, Ford was heavily invested in international growth, especially in China. For years, China was seen as the golden goose, a booming market of middle-class consumers hungry for big, bold American vehicles. Ford doubled down, exporting premium models like the Mustang and Navigator, and even opening joint ventures with local manufacturers. At the same time, Ford relied on complex global supply chains. Parts were sourced from dozens of countries, assembled in different regions, and shipped around the world. It was efficient, but fragile. The moment tariffs hit, the entire system cracked. With its global plan suddenly in trouble, Ford had to react fast. The company suspended its annual financial guidance, saying it could no longer predict how things would play out in such a volatile climate. Executives warned that tariffs could cost Ford up to $1.5 billion in earnings this year alone, a hit that could ripple through its operations worldwide. CEO Jim Farley admitted that the full impact is still unclear, especially as competitors weigh their own strategies and global markets remain unstable. One of Ford's first major moves was to stop exporting some of its most profitable vehicles to China. That includes the F-150 Raptor, Mustang, Bronco, and Lincoln Navigator, all high-margin models that brought in $330 million in revenue from the Chinese market last year. Losing access to such a lucrative segment puts Ford's long-term global strategy into question. For a company already dealing with rising costs and tight margins, this export freeze is a heavy blow, and it's only the beginning. Ford's decision to hold exports to China comes at a steep price. By pulling out high-margin vehicles like the F-150 Raptor and the Lincoln Navigator, the company is walking away from up to $900 million in annual profits. These models were some of Ford's biggest moneymakers in the Chinese market, but the pressure doesn't stop there. Tariffs on imported auto parts, especially from Canada and Mexico, are also driving up the cost of production in the U.S. That means Ford now has to spend more to make the same vehicles, squeezing already thin profit margins even further. And then there's the electric vehicle division. Ford is heavily investing in EVs to stay competitive, but this year alone, that part of the business is expected to lose $5.5 billion. Combined with tariff-related losses, it's creating a financial storm that's difficult to navigate. Meanwhile, Ford's position in China is becoming weaker. Local automakers and fast-rising EV brands are capturing more of the market, leaving foreign brands like Ford with shrinking influence and fewer options. In short, the company is getting hit from every direction. Higher costs, lower revenue, and increasing competition, all at the same time. What happened at Ford doesn't stay at Ford. These decisions are starting to ripple through the entire U.S. auto market and directly affect consumers. As production costs rise, car prices are going up. On average, new vehicle prices in the U.S. have jumped 13.5%, or about $6,400 per car. much of it driven by tariffs and supply chain disruptions. Ford is already considering price hikes of 5% on US-made vehicles and as much as 15 to 20% on imported models. That means everyday buyers will end up paying thousands more for the same vehicles they could have bought last year. And higher prices don't just hurt consumers, they hurt demand. When people stop buying cars, dealerships suffer. When dealerships suffer, so do factory workers, suppliers, and transport companies. It's a chain reaction that could lead to job losses and slowdowns across the economy. So while this might seem like a corporate issue, it's really a national one. The trade war is reshaping the market, and average Americans are the ones stuck with the bill. Ford isn't the only automaker feeling the heat. Industry giants like General Motors and Stellantis have also suspended their financial guidance, citing the same uncertainty around tariffs and global trade tensions. GM has gone as far as warning investors that tariffs could cost the company up to $5 billion. Like Ford, they're being forced to reassess production strategies, pricing models, and global operations in real time. Ironically, some investors still see Ford as better positioned, mostly because it builds more of its vehicles in the US compared to its competitors. But that's hardly a safety net when the entire industry is under pressure. At the same time, automakers are dealing with other challenges: quality control issues, expensive recalls, and concerns about whether they can sustain dividend payouts. These problems, combined with the tariff crisis, are creating one of the most volatile periods the auto industry has seen in decades. The message is clear: no company is immune, and the margin for error is getting thinner by the day. Beyond the auto industry, the long-term effects of the tariff war are beginning to show up across the broader U.S. economy. According to estimates, these trade tensions could shrink the country's GDP by $12 to $16 billion each year. That's a massive hit, one that could drag on economic growth for years to come. Even more concerning is the impact on lower-income households. Tariffs function like a hidden tax, raising the price of goods across the board. And when basic transportation becomes more expensive, it's everyday families who suffer the most. Meanwhile, U.S. exports are declining, global supply chains are shifting to other countries, and America's reputation as a reliable trade partner is taking a hit. For an economy built on global commerce, that's a dangerous place to be. This isn't just a temporary disruption, it's a fundamental shift, and one that could reshape the way America does business for a generation. Ford now finds itself at a critical crossroads. To survive this moment, the company will need to cut costs, adjust its pricing strategies, and rethink how it competes in both domestic and global markets. But it's not just about Ford. The entire U.S. auto industry is being pushed to adapt, or risk falling behind. Tariffs have disrupted decades of planning, upended supply chains, and introduced a level of uncertainty that shows no signs of slowing down. For workers, the future means job insecurity. For consumers, it means paying more. And for automakers, it means learning how to build resilience in a completely changed economic landscape. This trade war may have started with politics, but it's ending with real-world consequences for businesses, families, and the future of American manufacturing.